All right, so it's 11:10. Let's get started. So the first paper today is called Elusive Safety, the New Geography of Capital Flows and Risk. And Esther will present it. So the screen is yours, Esther.
So can you hear me well? Perfect. Okay, so thanks a lot for having the paper here. The paper is co-authored with Laura Alfaro at Harvard, who has also joined, so she can step in for questions. And Ruth Judson and Tim Schmidt-Eisenlohr, who are basically handling the data at the Fed. I mean, in fact, the paper is based on a set of facts, and based on that, we also build a model to explain those facts. And the facts come out of this TIC confidential data set. The data set is very special for many reasons. I mean, it's highly confidential, it's very granular. I will come back to that. I mean, of course, with some hypotheses, we went through them, and I'm going to show you just a couple of motivating slides. Two main findings that we connect together. Here you see basically the flows or claims and liabilities. The data set, by the way, is about US residents holding claims vis-a-vis the rest of the world, and the foreign residents holding liabilities vis-a-vis the US. What you see here is that around 2010, so more or less the time in which there's been an increase in regulation throughout the industrialized world, particularly after the Dodd-Frank Act and the Bank Secrecy Act all over the world, you see a big spike in flows, particularly liabilities, but also claims toward and in and out the Cayman Islands. We plot here the Cayman Islands because this is really the biggest share that we see. But in the next slides, we do the breakdown for debt liabilities between tax haven, the red one, and non-tax haven, the blue one. And you can see again that after the crisis, so around 2010, when there's been an increase in regulation in industrialized countries, you see this big increase in the tax haven intermediated funds. And I mean, this is striking because the numbers are not small. I mean, this is the 62% of all US debt liabilities. We know that US debt liabilities are very large, although, you know, Cayman and tax haven are less than 2% of world population and about 6% of world GDP. So, I mean, what you can think of is that those flows are going there not because there is production there, it's just they are just being intermediated. And you also have to think that actually taxes in tax havens were always zero. So really the trigger event, it's this change in the regulation. So, I mean, this is very important. There is a general literature trying to explain with macro facts. There's a large literature, which I'm not going to do justice, explaining the US imbalances with macro hypotheses. But actually, I mean, what this trend speaks about is that there might be micro incentives like tax avoidance and regulatory arbitrage that push the flow to gravitate toward the tax havens. And the micro origins could never be really, or the micro incentives could never be really studied because there were no good data. So why is our data set very good? I mean, first of all, it's very granular. Ruth Judson, who has been compiling this for years, you can see it both at issuer and investors level. So it can be meshed with basically any micro variable. In this paper, we focus at country, type of asset, and then sectorial level of asset. But going forward, we also plan to look at really firm level data. The important thing is that can be matched with a number of micro variables, so it can explain you what are the micro origins of this. It is very extensive in terms of time series, and it contains both claims and liabilities. So you can see both sides. Not only, but most importantly, I mean, this is not, credit reporting, credit agency reporting, but it's really an official reporting for which, I mean, there has to be accuracy, because if there is some mistakes or misreporting, there are punishments. What are the main takeaways that we give in this paper? I mean, first of all, we do the analysis, I would say, in three steps. First, we look at stylized facts. And so we'll look at country trends, and we'll show you that they're mainly going to tax havens. Second, we look at sectorial stylized facts. So we match this data with measures of risk, uncertainty, Sharpe ratio, and intangibility. And I'm going to tell you in a minute what are the main results on this. And then precisely because from the stylized facts, there's this clear trend that around regulation event, there's been all this passion for going to the Caribbean sun, then we start to ask what kind of, what kind of micro incentives are there. So we look at two different econometric specifications, one at sectorial level, where we interact intangibility with taxes, and one gravity equation, which is at country level. And what we find out basically is that there is a role for taxes and pre and post regulation. And then we're going to rationalize all of this with a model that is basically a merit style model. So the idea is that firms enter, they produce in the large country, they enter the tax haven. They are heterogeneous, not in terms of productivity, but in terms of firms default. What we find is that the combination of a difference in tax or regulatory arbitrage and a decline in the interest global market interest rate that triggers the appetite for returns of investors, basically increases the liquidity that is channeled through the tax haven. More of the firms enter the tax haven, and this basically means that the marginal firm that enters the tax havens is riskier. All together, as you will see, basically the model, it's merits with heterogeneous firms in default probability meets debt contractual agreement with endogenous monitoring. So you will see that, in a minute, I will tell you a little bit more, but the whole mechanism is basically an increase in extensive and intensive margin of risk when those firms go into unregulated tax havens. Let me also summarize a little bit the facts because there's very little time, so I'm not sure how much of the many results we have we can go through. So macro facts that we find is that much of the claims liability are intermediated through tax haven financial center. So THFC stands for tax haven financial center. There has been an increase after 2010. On the other side, because we can also see what happens to the safe assets, so to the special asset, which are US Treasuries. US Treasuries are mainly held by foreign officials, so municipalities, governments, and so on and so forth. So all of the safe asset is held by official, and all of the private is intermediated through the tax havens. Then into the macro facts, when we match sectorial flows with measure of risk Sharpe ratio, we find that the flows that are in tax haven are riskier. Investors that intermediate through tax havens require higher Sharpe ratios, so higher return. So this is typically search for yield. And the firms that issue through tax havens are mainly intangible firms. So it's typically firms that after the Dodd-Frank Act, they have troubles getting funded in the US, because in the US, after the Dodd-Frank Act, intangible assets cannot be used as collateral. So those firms, in a sense, are forced to go to the tax haven, and there they find plenty of liquidity through the global investors and cheap rates. Our gravity confirms the fact that indeed corporate taxes raise liability through tax havens, and also through some interaction terms with the post-2010 on also the claims. And as I said, what the model, the main intuition of the model is going to be the following. When interest rates were going down, liquidity has become, funding has become cheaper. It was easier for certain firms to get funded in tax haven where unregulated global banks were offering cheaper funds. Once those riskier firms enter tax havens, so the extensive margin of risk increases, they also have higher profits because they are paying lower cost on funding. And because of this, they appear elusively safe. So they have higher profits. So in the end, those global funds also tend to monitor less in equilibrium. There is an endogenous monitoring technology. And because those firms appear to have larger profits, there is in the end also a decline in the monitoring intensity. So in the intensive, an increase in the intensive margin of risk. There is a large literature, which I really don't have time to go through, but there's a huge literature on FDI. There is, this issue of the tax haven is touching several strands. So for instance, all the people that are interested, like Saez and Zuckman are interested on, on taxation and inequality. They are looking at money that is going to tax haven. There is a paper by Fatih Guvenen and others that show that the oil productivity slowdown could be explained by the money going to the tax haven. There is, of course, a huge literature on the US global imbalances, the safe asset hypothesis. And now there is this growing literature to Jess is contributing very much with very interesting papers about the changing landscape of the capital flows. In fact, he has a paper as well where he documents this flows toward the tax havens. So as I told you before, the TIC data that we use are really, really very good. I mean, they're very highly confidential. I think only Root has access to that. But they have a lot of information, granular information in terms of type of assets, type of investors, type of issuers, and they have a very long time series. Now, let me start to document the macro facts. I mean, what you see here is US holdings of, one moment that I have to move this, US holdings of foreign securities per type of assets. I mean, this is the top 10 countries. What is striking is the following. You see Cayman here, you see a big increase, okay, in holdings. And most importantly, the pink one is equities. So what this is telling you is that Cayman is mainly holding private debt from the United States. It also happens to be the case that Cayman uses dollars. So much of this claims to the, I mean, here now I'm showing you claims, but most of these claims is in dollars, in US dollars, which is in general a dominant currency. But in this case, it is because mainly because Cayman is using dollars. Here is another macro fact that I mentioned to you before, which is the fact that most of the treasuries, which are here, are basically, let me try to enlarge it a little bit. The treasury are mainly held by the official sector, okay? While you see that corporate debt and I mean, other securities are mainly held by the private sector, okay? So imagine those two trends, all the private debt of the US in and out, flowing through the tax haven, and all the safe assets going to the official, okay? And in fact, from now on, basically what I will do, I will focus on the private debt because this is what, our model will be about. One second, I don't know what happened now here. Okay. I'm going to focus mainly on private debt because this is where we are going to match also with risk and other things. I'm going to skip this because probably it's breaking down in other type of assets, but it's going to tell more or less the same story. I mean, for instance, here you see that Japan and China, they mainly hold treasury, the blue thing, it's mainly treasury, while Cayman is mainly holding corporate equities or corporate debt, okay? So same stories that I told you before. Now we're going to zoom deeper and match with the industry level. And we're going to ask whether those flows are riskier, whether, they are associated with risk taking or not, and what type of industries is this. So what we do is that we match with risk metrics, Sharpe ratio, and intangibility index. They are computed, for instance, risk metrics are volatility or uncertainty computed through the Gilchrist-Sims-Krajcik type of measures, and the intangibility index, we use this index that includes both R&D and marketing expenditures, okay? So, we try, of course, with different things, but the picture that you see here is basically confirmed under our specification. What you see is that, again, after 2010, the risk, the realized volatility, so the risk of the flows through the tax haven has increased, and it has increased more in the tax haven than in the non-tax haven. Here you see, for instance, China and Germany are down here, while Luxembourg or Ireland or Cayman are much higher. Sharpe ratio, so investors that invest from the tax havens also require higher Sharpe ratio. So the red line is Sharpe ratio of tax haven. It's increasing and it's higher in tax havens than in non-tax havens. Maybe this I'm going to come back later. Another important thing is that we see here there is a correlation between debt risk and uncertainty. So not only those flows, and the bubbles indicate basically the amount of flow, so the importance of the flows going through the tax havens. So not only those flows are riskier, but they are also more uncertain. So along all measures of riskiness, they confirm the same thing. And the other important thing is that
you have 5 minutes from now.
5 minutes. Okay. So as usual, we don't manage to arrive to the end of this paper, but anyway, so another important fact is that you see that those risky assets are mainly from intangible firms. So firms that are going there are mainly those that have intangible capital. Now, I mean, just briefly on taxes and the role of taxes and regulation. What you see here is that we have a gravity where we see that liability are mainly determined by, I mean, liability have been increasing toward the tax havens. Okay, so I've been gravitating more heavily toward the tax havens, and particularly so after the 2010. And another specification that we use that we think it's interesting is this one that shows, I mean, it's the regression of US liability over the tax rate, the corporate tax in tax havens interacted with the intangibility index. What it means is that a reduction in the corporate tax increases a country's holding of US liabilities. Now, I'm going to briefly tell you how we rationalize this, but of course, I'm not going to be able to go through the entire model. So we build up a general equilibrium model where firms produce in the US, but they open a PO box in the tax haven, and they are basically going to use this in order to issue debt or raise debt there. They do so through global intermediaries that are unregulated. And what the global intermediaries do, so there is a production side of the model. Those firms are heterogeneous. They produce different varieties. They have some market power because of the elasticity of demand, but they are heterogeneous in terms of their risk. Okay, so the threshold firms that enters or that decides to fund in tax haven is basically tell you, whether the pool of firms that is in the tax haven is more or less risky. What the very important thing is that, the riskiness is basically determined by the monitoring intensity. So it's determined by, the threshold firms that enters, that's this extensive margin of risk, but there is also an intensive margin of risk, which is the probability that the debt of this firm is going to pay zero is going to decline with monitoring. Now, the global bank that is in the tax haven is going to raise the issue debt for the firm according to an incentive compatibility contract. And the key thing of this contract is that also monitoring is chosen endogenously. There's no way I can go through all of this, but let me just tell you the main thing and you want to bring home. So whenever there is a reduction in interest safe rates globally, global investors that go to the tax haven require a lower compensation. So that basically means that funding in tax haven becomes cheaper, more firms enter, but given that firms are heterogeneous in terms of default probability, that means that the marginal firms that enters become riskier. So the extensive margin of risk in the tax haven, the extensive margin of risk increases. Not only, but once they are in, they pay lower cost, so they have higher profits, and they appear elusively safe to those global funds that monitor less. And so in the end, the decline in the monitoring intensity is also increasing the intensive margin of risk exposed. We have some simulation where we confirm this, but let me wrap up. And thanks to Jesse for agreeing to discuss this paper. I mean, he's well-versed in this literature.
Great, thank you so much, Esther. Yeah, so now we have Jesse Schreger to be the discussant. Screen's yours, Jesse. And you might need to unmute yourself.
Done.
Yeah, Jesse, you're muted.
You can see me?
Yes, now it's perfect.
Perfect. So thank you all so much thanks to the organizers for the invitation to discuss this paper. So let me jump right into it. So I think it's a great paper. It covers a huge amount of ground. And so I'm going to focus my discussion on what I think are like the main results. So broadly, what the paper is doing is it analyzes portfolio flows, so stock and bond flows between the US and global tax havens. I think the main findings of the paper are on the so-called US liability side, that tax havens, so investors in tax havens, buy riskier bonds in the US than do other foreign investors. The authors then construct a heterogeneous firm model with multinational funding structure in order to rationalize these findings. And so mostly what I'm going to talk about is some suggestions for how the authors can kind of dig into their main findings and some suggestions for where I think the model and the data could be brought a little bit closer together. So for those of you who haven't really thought too much about tax havens, let me kind of give one slide for why I think this question is just super important. So I took the TIC data for 2019. I obviously don't have the confidential version that they have. Just in the publicly available data, all I did is I took the Torslov, Weir, and Zuckman classification of tax indices and basically summed up, who owns, who's investing in U.S. portfolio liabilities. And what you can see is that, tax havens here, the sum of all tax havens are going to account for around $8 trillion of investment in the U.S. You can contrast that with, how much we know about what China is buying in Treasuries, or, you can look at the Norwegian Sovereign Wealth Fund and see, what they're buying in the U.S. Fundamentally, this is kind of $8 trillion of investment in the US, and we really don't know much about what these tax havens are buying. So it's a really big question to understand this. The kind of first cut that you could see for how tax havens are different are literally just to ask, from the paper, what types of assets do different countries buy in the US? And so if you look at kind of Japan and China, what you can see is that it's mostly agencies and treasuries here. But contrast that with the Caymans. Immediately, you can see that the overwhelming share is not agency and treasuries, but corporate debt and equity. And so most of the analysis that what they're going to do is going to be kind of the more micro level, but immediately you see that among the three biggest creditors of the US or in the portfolio space, there's kind of a major heterogeneity in what they buy, a big difference between what tax havens and everyone else are going to buy. Now, what do I think is kind of the main result of the paper? It's this idea that tax haven-based investors buy risky stuff. And I want to kind of walk you through what what the authors mean by that. So they'll have kind of three distinct measures of the riskiness or the compensation for risk of what investors buy. And so if you look kind of in column 2, what you can see is that the volatility of the realized volatility of the investments from tax haven investors in the US is higher than non-tax haven investors, and the R squared of that is relatively high. Similarly for the Sharpe ratio and the Gilchrist et al. Measure of uncertainty. You kind of see something like that for equity, but it's much stronger for debt. And so I think that's why the authors are really going to kind of focus on the kind of debt results. They also find that the investment of tax haven-based investors in the US is actually more concentrated in industries that have less tangible assets, which they think points to the idea that, hey, these industries are kind of more inclined to profit shift. The graphs that I think really kind of summarize what I think the paper does are these two. And so let me slow down and walk you through exactly what that is. So they kind of split the liabilities of, the debt liabilities of the US. So this is foreign investors owning, debt issued by US entities, and plot against the realized volatility. And what you can see is at the beginning of the sample in 2007, non-tax haven based investors actually bought, what they'd say is riskier stuff in the US. By the end, tax haven based investors are buying riskier stuff than non-tax haven based investors. And this is kind of the pattern that I think comes out most strongly in the paper. And it's something, that we don't know very much about. On the right, they kind of split this. You can not just look at all tax havens, but you can compare individual countries. And so what they basically find is that the tax havens of Luxembourg, the Caymans and Ireland are buying riskier stuff than kind of the real creditors of Germany and China. And so I think of that as kind of the main findings of the paper. And I think this is a really interesting result. And so there's obviously a lot going on, but I think that the paper could really benefit by kind of digging into this result a bit more. So kind of basic questions that I had when reading this. So I should say, as Esther mentioned, everything is currently done at the industry level. I know she mentioned they're getting firm level data, which is incredibly exciting. But right now, what they're doing is they're really asking, tax haven based investors are investing in riskier industries than are non-tax haven based investors. But I'd love to see something as simple as kind of which industries are tax havens, more overweight. What is really driving this result? Is it, they avoid utilities, they invest in tech, things like that would kind of help me understand exactly what's going on. The other thing is they seem to use a time invariant measure of industry risk. So you basically calculate, how, this is the risky industry, this is not the risky industry. But I think there's a lot of questions about, you see how that change in the riskiness of tax havens and non-tax havens over time. It really raises the question of, could variations in risk just be coming from, tax havens and non-tax havens switching their industry composition of their portfolio? Or is it possible that when the riskiness of an industry changes, tax havens rebalance to it, and other tax havens don't? I think also kind of given their data, not all tax havens are the same. And I think there's a real opportunity to kind of dig into the differences in what these tax havens are doing. Because I really see this as the main result, something that's really interesting. And so kind of the more that I could know about what's driving this, kind of the more I would know what to do with the paper. Now, what do I think are kind of the issues you hit when you use industry data? And again, I think they're hoping to go beyond this. But right now, when they say riskiness of investment, what they mean is the riskiness of investment portfolio based on industry level variation. And so they're going to calculate the realized volatility and Sharpe ratios as the industry average weighted by relative holdings. So kind of the first very basic question I had, the paper implies that they're basically going to calculate this riskiness of an industry for stocks and then apply it to bonds. I wasn't exactly sure if that was right, but if that is the case, considering that the paper is about bonds, I think that it's pretty important to actually confirm that the riskiness of industries by stocks and bonds are actually going to be the same, because you actually imagine that the composition of debt across an industry could differ very, very much, something I'll return to. The other big question I have that I think they'll be able to go into going forward is just the idea of how much heterogeneity is there across average risk. So the average riskiness of industries, so the riskiness of utilities versus tech relative to the riskiness of firms within an industry. And I think that, kind of conceptually, if you have the kind of micro tick data, the kind of real benefit you could see is it's not just that, you couldn't just show us that the tax havens invest in tech, but non-tax havens buy utilities. You could really kind of zoom in and see how much are they tilting their composition at the firm level. Because my sense is there's probably going to be a lot more within industry variation than this time invariant cross-industry variation. I also think that this is going to be, kind of digging into the source of this riskiness is particularly important by bonds. Because when you're buying, debt, there's, and I would think of the riskiness, I would think of, what's the currency of the debt? What's the duration of the maturity? If it's a paper about risk, fundamentally, you could just see, how different is the credit rating of the securities purchased by tax haven-based investors and non-tax haven investors. And so I think that kind of more generally, if the paper is about, the relative riskiness of the flows, I come away with the question of, why would industry be the natural starting point? I think that what they've done so far is a very, very nice evidence that there is heterogeneity in this industry level, but particularly given the rich micro data, I think that there's kind of a lot more that could be done there. Now, let me walk through the model before I talk about how I think that the data and the model could be connected a little bit better. So what's the kind of key question faced by a firm in the model? Basically, you want to think of an American firm that's contemplating, should I become a multinational? And by that, they mean, should I form a financing affiliate in a tax haven that exists to issue bonds? Now, why would I do that? The benefit of doing this is that if you have a tax haven affiliate, you basically lower your interest rate on your stock of debt because you can have profit shifting. What's the cost? There's a fixed setup cost of forming your financing subsidiary. And so kind of what's the result of this model? With this kind of fixed cost but lower variable cost, you get kind of a very nice kind of threshold idea that only a fraction of firms are going to endogenously form an affiliate. And the key idea that they emphasize is that a fall in the global risk-free rate is going to lead riskier firms to enter. I should say this would be something that would be very nice to kind of test directly in the data. This second result is something I don't kind of see that empirical parallel for. But what's the idea of this main result? So the idea is that the lower interest rate, an increase in global liquidity, is basically going to lower the marginal cost of firms, which is going to increase the optimal size of firms. And so that's going to mean it's more appealing to more firms to pay a fixed cost to lower their interest rate on the stock of debt. So for those of you familiar with the Melitz model, you want to think of the comparative static as being equivalent to, I increase the size of world export markets. Now you're going to see lower productivity firms finding it optimal to pay the fixed cost to access foreign markets because the value of foreign sales could increase. And they have something very similar that's very nice in terms of the selection into firms by their riskiness. Now, here's where I want to be precise about kind of what these different terms are actually going to be measuring kind of in the data and the model. So in the data, what is a US liability from the Cayman Islands? This is the stocks and bonds issued by American resident entities, so firms that are owned by Cayman domiciled investors. US claims on the Cayman Islands are stocks and bonds issued by Cayman resident, I'm always going to use CYM for Cayman, by the way, Cayman resident entities that are owned by American investors. The model, I think this is something I'm a little bit unsure on. I think the model is actually closest to bonds issued by Cayman resident entities that are owned by Cayman domiciled investors, which I'm gonna come back to. I think they're kind of after the idea that it's designed to capture when either side of the transaction is the Caymans, or I couldn't quite see what it was, but I'll explain kind of why I think that this distinction matters for how much we actually know about what's going on. So to do that, let me kind of draw a super simple financing structure of a firm and talk about how, basically what we're able to measure using the TIC data and what we're not able to measure using the TIC data for the connection to the model. So I wasted a lot of time on this, and the best generic American company name I could come up with was Samco. So I have an American firm, Samco, that's sitting in the United States. I'm going to use this line here, by the way. Anything on the left is something occurring in the United States. Anything on the right is in the Cayman Islands. Okay. Plain vanilla bond issuance. Samco issues a bond in New York. That's an American bond. Okay. That's the way we usually think of it. In the model, Samco can pay CHI, that's the fixed cost. And what do you get for paying this fixed cost? You open up SamFin, the financial affiliate in the Cayman Islands. Now, what can this affiliate do? It basically exists to issue bonds that can then essentially be used to finance the production of the real company, Samco, occurring in the United States. Now, you can think in reality that there's a couple ways in which, obviously there's the rest of the world here, but let's just imagine two cases of investors for who's actually going to buy these bonds. So I have US households on the left. It's the same if you think of a US mutual fund or pension fund or whatever. The right is a Cayman Island-based mutual fund, okay? So let's go through the different kinds of transactions that can occur. So what is the TIC claims data, okay? An American household can undertake two transactions. They can first directly invest in a Cayman Island fund, okay? That, in the language of the TIC data, is going to be it's a US portfolio equity claim on a fund share in the Caymans. So in the graphs, that's going to show up as equity investment, and in particular, it's a fund share investment. They can also buy the bond of the Cayman Islands, the Cayman Island-based firm, and the way they would do that if they did that is, they would basically buy a bond domiciled in the Caymans, and here you would see this is a flow of an American householder fund buying a Cayman Island-based bond. That's what you'd see in the TIC data. Now, what if an American household buys an American bond? That's the kind of flow that you won't see in the TIC data. The Treasury International Capital data is cross-border financing. And so domestic flows are not going to be there. So, we won't see this in their data set. Let's say you have a Cayman Island-based fund now buying an American bond. So this is what I think they really see. This is the TIC, USA liabilities. This would be recorded as a Cayman fund buying a bond of an American entity. Something I think is important is, let's imagine that this Cayman Island-based fund buys a bond issued by SamFin in the Cayman Islands. This is not a cross-border investment. This is a domestic investment in the Cayman Islands. And so this is actually something that you can't observe in TIC. And I would think it's actually kind of the type of transaction that you have the least information on, because here you're relying, you'd be relying on the Cayman Islands domestic reporting, which is something, at least I don't know very much at all about. And so the key here, I think, for the connection to the model, a lot of what's—
We have 5 minutes, Jesse. Just a
Perfect.
reminder.
Great. What's currently being modeled is, I think, closer to this kind of flow, which is actually the one that we don't necessarily see very well in the data. And so something I think that would at least help me a lot is kind of using this diagram. What I think that the authors really see in the TIC data that I think is an important result that I would kind of love for them to dig in on, it's not the flow from the Cayman fund to the Cayman bond. That's not what they're seeing so much. What I think that they're really seeing is these Cayman Island-based funds are more inclined to buy the bonds of, now I have 3 firms, a risky company, a safe company, and my original firm. What they're really seeing is that these Cayman funds are buying the bonds of risky US companies. And I think this is what's going to come out a lot more in the TIC data. And so I think the heterogeneity that they're really observing is, are they more inclined to buy the bond of the risky firm or the safe company, or potentially my original firm? But what's very hard to say is, are these funds going to actually be buying the stuff in tax havens? And so because I think that that kind of main result on the riskiness of what they buy in the US is so sharp, I kind of love to see the model actually connect to that main result a bit more directly. And so one thing that really kind of comes out of this discussion of what you can and can't see is just how much of what the facts they've documented are about really, and I think this is genuinely important, what tax haven-based investors are actually owning. It really raises the question of, what does an investment from a tax haven really mean? And so, as Esther mentioned, no one's living in the Cayman Islands. Anytime you see the Cayman Islands, it's a stand-in for somebody else. And so this really puts front and center something, this is beyond their paper. This is kind of for the literature of, what does an investment from a tax haven really mean? Because you can imagine that, these tax haven-based funds, some of them might be bought by Americans and some of them might be bought by Germans. And we fundamentally don't even know if these funds are going to be buying different things depending on, which type of investor they're catering for. And I think related to that paper, to this paper, what it really asks the question of is, do tax haven-based funds lead investors to take more risk? Or is it possible total risk taking is the same, but risky stuff is done in tax havens? And so let me kind of draw with my kind of favorite graph in the paper what I mean here. So I'm pretty sure that this is the total risk that Germany is taking over time. So you see this kind of declining and staying low. But at the same time, what you see is Luxembourg, increasing. And similarly, you see Ireland increasing, okay? Now, what is Ireland and Luxembourg? Those are kind of tax havens that sell UCITS, fund shares to German households and other Europeans. And so when I see this main result, it really raises the question to me of, is this Germans, taking more risk by going to the Cayman Islands? Is this stuff that used to be done directly by Germany moving into these centers? Or is this a fundamentally new economic activity that would not have been taking place if it wasn't for the ability of funds to set up in these low tax, low reporting jurisdictions? And so with that, just to conclude, I really like this paper. I think it's super ambitious, that makes very nice. It's kind of rare you can find something this big that we know so little about. And so I think that with an increasing share of global capital flows intermediated through these tax havens, it's important to understand kind of the causes and consequences. And I think particularly on a lot of the empirical suggestions I made, I'm really excited to see what the authors can do with the firm level data going forward. So thanks so much.
Great, thank you so much, Jesse. I guess we can start it with Esther responding Jesse for 2 to 3 minutes, and then we can open the floor. We already got 3 questions, and please also feel free to type in more questions.
Okay, great. Thanks a lot. Maybe I'll try to go quick, just in case that Laura maybe wants to add something. So first of all, Jesse, I think it was a great discussion, because I mean, you really clarified the main point, and you know those data, I mean, those type of data and flows very well. And so I think that all the points you made are definitely very clever and very useful. Now, there are a number of suggestions which you gave, and I think they are very useful. We should definitely do them. So digging further in, let's say, within and between industry heterogeneity, this we can do it also with the sectorial data, and we should do it. I agree. So that's a great idea. The heterogeneity across tax haven, same thing. Let me tell you one thing about debt and equity. So you're right, we should probably clarify even better the fact that when we construct, it's a kind of practice in the literature that when you construct the realized volatility for debt, you use the same prices for the ISIN taken from equity. So we do something similar in the literature. But of course, you're right that debt might be slightly less risky than equity. Now, we can check with credit rating. So we can take your suggestion. I am a little bit skeptical with credit ratings because we know that a lot of it is collusion, right? So you see A, and then you go into the volatility and you see that the market is pricing them differently. But your point is well taken that we should double check with different sources whether there is really a big difference between debt and equity. So this is well taken. Another important thing is you mentioned that we should probably do more in the data because in the model it's well spelled out, but in the data it is less, this extensive or intensive margin. So you asked, is it that riskier sectors are entering, are funded in tax havens, or that the risk has increased? We should probably check better this even with the sectorial data. But as you said, really the proof of the pudding will be the firm level data because there we can be much more granular on risk. Your point on the connection of the model and the data is great. And I think all the examples you made are precisely the examples that are possible. So, the Cayman residents are not Cayman. There are 10 people in Cayman. So it might be Jesse going to a fund in Cayman. So as you said, we don't know the ultimate really because otherwise they wouldn't go to Cayman, of course. But let me tell you what is the spirit of, and I think you're right that we should clarify that the model is not capturing, firms resident in Cayman and being funded by residents in Cayman, because this is something we don't see in the data. So we should think of a better example to fit the model. But the main point, the punchline is, this could be an affiliate with some different form of incorporations, which have been already hinted by Desai. And those could be maybe, my firm is not even resident in Cayman, it's just issuing debt, and it goes through the fund, and it's German or American investors. But I agree with you, we should make an example that really fits better to, there are many possible examples, but we should take one. The very last point, and then maybe we'll see if Laura wants to say something. I think this is also a very clever idea. So is this new economic activity? You say when Germans go and invest in Luxembourg, is this new economic activity? In part, yes, it's the growth of the intangible economy that can only be funded in tax havens. Yeah.
So I think you raised great points, and you nailed it, that we need to do a better matching of the model and the data. Let me explain you why we started with industry and have been slowly moving into firm. So it turns out that firms are not required to use a standard ID. So Ruth has been matching against tax data to get to aggregate. And that, as you can imagine, A, only she can do it, and then B, is, as it is, a slow process, and C, the pandemic hits, and so everyone who works for a Fed knows that they have more work. So that has been the restriction in the firm level. On the industry level, it turns out that A, not all firms fit nicely into one industry. We tend to do that, but many firms are multi-product. But beyond that, as you know, there's a lot of mutual funds there, and it's hard to classify mutual funds. Sometimes the vendor provides classification that Ruth knows it's wrong, and so she has to check. So all this checking meant that when taking the trade-off, it was easier to start with industry and then moving to firm, but that is what we want to do. We have some indirect evidence on monitoring intensity, we started to look at some bond covenants, and as you guys probably know better than I do, there has been a movement towards lighter covenants. And so again, that is some suggestive evidence on these monitoring intensity, because as Esther said, I don't like a lot of ratings. I know that a lot of the CLOs are going to be AAA. I just watched the Big Stuff movie with my daughter yesterday, so I cannot do AAA again. And you're right, the model, we need to do it better, but it is true that Caymans buys a lot of stuff from the US, but it turns out that the other way around is also true. And that is sort of the idea that we have, this back and forth, but I agree, we need to do a better job matching and the model and the data, and we're hoping to do that as we progress with the firm. But as always, great comments, and nice to see you again.
Great, thanks so much, Laura. Okay, let's open the floor. I think the first question is from Fabrice. Do you want to unmute yourself and ask live?
Oh yes, hi. Yeah, this might be like tangentially related, and this also reflects my lack of knowledge on this tick data. But I mean, the entire structured finance market relies on the creation of special purpose vehicles, mostly all incorporated in the Cayman Islands, mostly to avoid double taxation type issues. And so, if you look, for example, at the CLO market, which is a $600 billion market today, this is a market where you have an SPV established in the Cayman Islands buying, leveraged loans issued by US high yield firms, and then issuing securities that are sold back to, US, insurance companies, banks, pension funds, and also investors across the world. And so, I mean, at the end of the day, it feels to me, if structured finance issuers established in the Cayman Islands are indeed in the data, I mean, shouldn't we just be considering them as a veil and sort of ignore them for questions related to portfolio choice? And I mean, so I don't know the extent to which those sort of Cayman companies are in your data set.
So I think that the issue, I mean, Jesse explained it a little bit. So first of all, these flows are huge. And they've started, even Jesse has a paper with Morningstar data where they showed it, a lot is gravitating there. Now, the question, I think your questions in the end boils down, is this important for macro? Yes. A lot, huge. And I'll tell you at least 3 reasons. So we point out the fact that it's risk. Now, the point is that, as Jesse told you, behind that is not the 10 residents in Cayman. If there is a crisis, it's in Cayman, who cares? No, it's Germans, it's Americans. This will spread globally when the bubble will burst there. Number one. Number two, there are papers already that, for instance, Stake, Zuckman, and Saez, they are telling you that a big part of wealth is moving there because high net wealth investors are moving there, and you don't see this in the inequality. So it impacts inequality, it impacts risk, it impacts the probability of crisis. And there is a paper by Fatih Guvenen and Kim Rule that documents that it impacts. They argue, you might believe it or not, that the shifting to the tax haven can explain the whole productivity slowdown of the United States. Now, so this is to tell you, if this is important, yes, because it's big, and because it's not held by the 10 Cayman residents, it's held by the world. You have to think of Cayman just like a big shadow bank that is sitting there because it's not under the Dodd-Frank Act. That's it, basically.
Yeah. So again, how systemic the risk is there, I don't think we should discount it until we understand what that is. Again, I just saw the movie Big Short, and precisely what you said is what we used to say about mortgage-backed securities. And so then we had a crisis. And in a way, it feels that a lot of stuff that was recycling Nevada and Florida now just moved to Cayman. And so again, that's what we're saying, that there's this intermediation there. And I think the fact that it moved there does suggest that we just need to understand a little bit better what that is before we dismiss it and move on.
They could have moved somewhere else if unless they have a passion for Caribbean sun.
Okay, great. I guess we have time for one last question. So Nick Rusano, do you want to ask?
Sure, thanks, Wenchen. So my question is about how much of this is really sort of global intermediation of risk and how much of it is pure tax arbitrage. I mean, you're capturing much of it with the idea of profit shifting to these tax-free jurisdictions. And just to push us a bit further, if you think of Jesse's figure that he drew, what you would call Cayman investors buying U.S. issued debt, right, would potentially include a Cayman financing subsidiary, the SimFin thing, buying U.S. issued bonds, which would give the same firm, of the Samco, which would give the firm the tax shield in the U.S. So while at the same time being able to channel these profits that are being captured in a subsidiary that accrue to their intellectual property back into the firm. I mean, these firms have enormous amounts of money sitting in these overseas subsidiaries that they cannot, bring back supposedly to put into investments. So what do? They buy their own bonds and capture the tax shield in the process. I don't know how much of this is going on and whether
so let me answer. So I think your question boils down, is it more tax avoidance incentive or regulatory arbitrage? And the answer is the following. So tax rates, I mean, Laura always, says this, tax rates in Cayman were always zero, but we didn't see this before. So there have been other things that have produced this. I mean, of course, there needs to be some kind of tax arbitrage, but there are two things that produce this. First of all, you need to have investors going there. And so the law, what we argue in the model, but I mean, this is also what we see in the data, is that the low interest rate in other countries moved maybe high net wealth investors into investing in these unregulated funds, because then they get higher returns, okay? So they are in search for yields. Let me finish. The second thing is that you see that this increase has really been after 2010, which is there were a number of regulations in Europe and in the United States. And on both sides. So for instance, Dodd-Frank Act says that intangible firms cannot use intangible as collateral. So imagine the growth of the intangible economy, all those issuers want to go there. Not only, but investor protections has increased enormously. I mean, investing in Germany is a nightmare. You have to fill this prospectus. And so you could imagine that high net wealth people, I mean, as also Zuckman and Zayas are arguing, maybe they want to have some kind of lighter regulation, higher returns, and it's very convenient. So my response is, I cannot really quantify, but I would say regulation has been really the trigger.
Can I just follow up on that real quick? I think you're absolutely right that regulation has been one of the drivers of this. I think the other one is simply technology, the growth of IP, and the fact that firms like Google and Facebook, they hold all their intellectual property in these low tax jurisdictions. And they want to bring that cash somehow to invest it back in the firm. And I think buying their own bonds I don't know how much of it is going on, but it seems like that's a way to go. That was not the case before, when they didn't have this incentive to hold these non collateralizable assets there. That's one thing. And the other thing, especially for locations like the Caymans and so on, a lot of the U.S. institutional investors in hedge funds, so also private pension funds and endowments and so on, that are tax-free, when they invest in US-based hedge funds, they would incur a so-called UBIT, unrelated business income tax. The workaround for that is these hedge funds are held in the Caymans to make sure that these tax-free institutions avoid paying taxes that they would otherwise pay. So it looks like, once again, it's a Cayman investors investing in US bonds, whereas it's US pension fund investing in US risky bonds, but they have to do it through the Caymans.
I think, Nick, all of the examples you are making, they're all compatible exactly with our data or our model. Let me just add one more thing. You're right. And in fact, in the paper, at some point we say the growth on the intangible economy means that you don't need to have credit near your plant. Physical capital cannot be moved so easily, but if you have just royalties and things like that, patents, you actually, I mean, Google was in Ireland. So yes, all of your examples are precisely to the point on what we are arguing. There is this kind of thin economy that can flow all over the place. Yes.
Perfect. Thank you so much. So let's take another 5-minute short break, and we'll reconvene at 12:10 to have our last paper of the program.
Jesse, many thanks.
Thanks, guys.
It was a pleasure discussing it.
Well,